Hey, what's going on, y'all? And welcome to How Do Credit Bureaus Calculate Your Credit Score. Today, I'm going to be breaking down the 5 FICO factors so you can demystify credit and accelerate your credit building journey. But before I continue, if you have not seen my first video, because this is a series, if you haven't seen the first video, I want you to go back to my page, my YouTube channel, wherever you're watching this, and go back and watch the first video so that you can hear my personal story, why I'm even qualified to even talk to you about all of this, what I've done for myself personally with my personal credit, fixing my credit, and things like that. And then make sure that you go back and watch it, take notes so that you don't miss any steps in the process. Everything is going to build on top of each other. I created this series so that the average person could learn about personal credit because let's be honest, especially if you're a part of this community, like we all know that credit is something that is kept very close. It's normally very private, and we don't really talk about it in detail. What we use it for, how much we use it, how we handle it, how we manage it, and stuff like that. We've just been raised that way. We need to talk about it. We need to have more conversations about financial literacy. We need to have more conversations about how to leverage credit and to not be afraid of credit and how to be more responsible with our money so that we can build a life for ourselves and not be so stuck all the time just because of the things that we don't know, right? So, with that being said, who is this presentation going to be for, right? Who's it going to be best for? It's really going to be best for entrepreneurs who know that in their future they want to go and access funding. You might not have a great wraparound in reference to personal credit, but you want to get a hold on it and you want to learn how to leverage it so that you can get to the money when it's time for you to start your business. And it's also for entrepreneurs who are out doing it right now. They're out in the trenches building their businesses, but they're struggling. You're tired of burning through your savings and your profits in order to run your business. It just seems like an endless cycle. And you want to be able to access more money so that you can really give yourself a leg up and actually scale your business instead of staying stuck. All right. So we're going to just get right into it. Now, when it comes down to your personal credit score, there's going to be 5 main factors that make up your credit score. It's going to be your payment history, your utilization, new credit, your credit mix, and your length of credit history. A huge 35% of your score. You can see that here. And this is why it's so important for you to pay your bills on time because it's a significant amount of your credit score. And if you make one late payment, you can imagine at 35% the amount that your credit score would drop if you miss a payment, right? Utilization is basically the amount of money that you're using out of the entire limit that you have. When it comes down to best practices with utilization, most people will tell you to keep it below 30%. But I'm going to tell you that in reference to getting new credit or business funding, you need to have your utilization or your personal credit profile below 10% to maximize the amount they're going to trust you with. All right. And now, new credit. New credit is just what it sounds like, new credit accounts. You will notice that when you apply for new credit accounts, your score might drop. And that's because of the way that credit age is calculated. We're going to talk about that soon. The credit mix is the different types of credit accounts, and there's two: installments and revolving. We're going to go into that in more detail as we continue on in the presentation. We have your length of credit history, which is your credit age. Your credit age is calculated by the average age of the accounts that you have open. If you have a 10-year-old card and 5-year-old cards, and your 10-year-old card for some reason closes because you're not using it, that's going to drop your score because of your age of credit history changing. All right. Now, let's go and break everything down individually. All right. Let's get into it. Now, the first thing we're going to talk about is payment history, right? And we all know is how well you pay your bills on time. But if you miss one late payment, your score can drop 60 to 110 points, and it can stay on your credit report for 7 years. 7 years, all right? And that is including collections and charge-offs. So you really don't want to mess around when it comes down to missing payments because it will make a huge blemish on your credit report and it will stay there for a very long time. Well, I've put together 3 payment hacks to boost your score and increase your credit limits. The first tip is setting up autopay, and that goes into not missing payments. Banks and lenders love it when you show that you're proactive in making sure that they get their money. Nobody wants to not be paid. So when you take that extra step to set up auto pay, which might not be feasible for everybody, just make sure you stay on top of your payments. Okay. Next, paying it 2 to 3 times a month. Lenders love when you show responsible payment habits, such as paying manageable amounts throughout the month to pay off the balance. If you're trying to increase your credit limits faster, what you want to do is you want to run up that card. So if you have, say, like a $500 card and you're trying to, increase your credit limit on there, use that thing for groceries every single time you go grocery shopping. Make sure that you have the cash for it and run it up, pay it off. Run it up, pay it off. Run it up, pay it off multiple times within the month. They should at that point, give you a credit limit increase after a couple months of activity showing that, hey, I need more money, but you're being responsible with the money because you're paying it off and paying it all back. That's a little hack to get your credit limit increases up a little faster. Make sure that when you pay your credit card bill and you have given yourself a low balance on that account, you stop using that card until it reports to your credit profile. And now what that's going to do is show consistent low balances on this account so that in the event that you go to look for funding, that they can see you are utilizing a minimal amount of your credit. And banks like to see below 30%, but they love to see 10%, 5%, basically showing them that you don't need their money. So let's get into utilization best practices, which I kind of just touched on, but we're going to go a little bit more visual for visual learners so you can see what it looks like. If we're trying to keep our credit in an excellent utilization ratio, we're going to try to keep it under 10%, right? And so if you have $1,000 card, that's going to look like $100 that you need to pay it down to $100 or just pay it all the way off if you're in a position to do so. But every single month you want to make sure that your credit accounts, based on your credit limit, that you're hitting this 10% when it's reporting to the credit bureaus to maximize your credit score and then maximize your odds for approval when it comes down to getting new credit products, because they look at all of that. All of this is reported. These are things that they can see consistent monthly history of. Pay attention to how things are going to look like. Think about, if you were a lender, how would you look at your profile and how much money would you trust yourself with based on your behavior that's showing on your credit profile, right? So the next thing we're going to go into is credit age facts. We're going to break that down a little bit. Now, credit age is the average age of all of your accounts. The older the credit accounts you have, the more credibility you're going to have. If you have a relationship with a friend, that you've been loaning them money back and forth over 10 plus years, you have trust with that person. Y'all have built good credibility with each other because you've loaned them money, they've paid you back. Now, if somebody comes to you that you haven't had this relationship with and they ask you for $1,000, you're probably going to be like, no, because you don't have established credit history with them. I mentioned this a little bit earlier, but in reference to older cards, like a lot of people have cards that they've had forever, and they're like, should I just get rid of this because I don't even really use it? The answer is no. Especially if you have good payment history on this card. If you have trash payment history on a card, let it go and just start over. That negative history is going to deter more lenders. It's still going to require patience to rebuild your account. For most lending products, you need at least 2 years of credit history. That's something everybody needs to consider when you're trying to get business funding. That is a real thing, the time constraint there. So get started today and get started the right way. All right. Next, we're going to talk about credit mix. All right. Now, what are the two types of credit and how do they work? The two types of credit are revolving credit accounts and installment loans. Revolving credit accounts are your credit cards, your lines of credit or home equity lines of credit. Because they're revolving, that means that you use the money on the card or account, pay it down, and then that money replenishes itself. And so now you can use that money again. If you pay it all the way down, you got a full line of credit that you can use again. Installment loans are different. Installment loans are something like a car note, an entertainment center, or furniture that you get financed. You have to pay a monthly payment for that every single month until you pay off that balance. These items, the cars, the furniture, the entertainment center, you have this. Now, these are what's considered like a secured loan, right? Like your car notes and your entertainment centers, your furniture financing, those are going to be considered secure loans, okay, because they have collateral attached to them. Your home equity line of credit is going to be a secured loan as well because your home is attached to it, okay? But typically, like business lines of credit or business credit cards, they are considered unsecured lines of credit because nothing is attached to it, okay? Except your personal guarantee that you are going to pay the money back, all right? Now, the next thing we're going to talk about is a Vantage score versus a FICO score. Now, some people may have never heard of a Vantage score. I know most people have heard of a FICO score, but your Vantage score is generally what you're going to find. Disrespectful. So let me tell you something real quick about this. This is a little blooper that happened. Took this credit mix over here and I put it over top of miscellaneous factors because that's not correct. This is supposed to say credit mix, but somehow the editing decided it wanted to move that when I'm recording. So you guys get to see it, which is fine. All right. Either way, your Vantage score is what you're going to find more on Credit Karma. And I don't know if you've had this experience before. Like maybe you go get an apartment and you've been looking at Credit Karma, monitoring your credit, and you go somewhere to get an apartment and they run your credit and your credit score is completely different than what you saw on Credit Karma. Now, that's going to be because most places use different scoring models to look at your credit, but like there's different models inside of like the FICO scoring models, there's different FICO scoring models. The Vantage score has its own model, the FICO score has its own model. And 90% of lenders use the FICO score. So when they came out with Credit Karma and this Vantage score, it confused a lot of people because it's easy access to see. It's free for you to get access to most of the FICO score information, especially getting access to all of your FICO scores across all three bureaus. It costs money to access, right? But Credit Karma, they're showing you basically everything. Most people are confused because there's a significant calculation difference between the Vantage score and the FICO score, and people don't even use, the majority of lenders don't even use the Vantage score. So if you learn anything from this presentation today, focus on your credit score. A great place to see your credit score, your FICO score, is going to be My FICO. I absolutely love it. I use it myself. Yes, you do have to pay for it to see all three credit scores. It's $30 a month for you to be able to see all three. If you're about to get funding, it's important for you to have access to know what your credit score is like and to see all the different scoring models depending on what you're planning to do. Because as you can see here, there are different lenders for mortgages, auto financing, and credit cards looking at different FICO scoring models to make their decisions for you. Okay. And so My FICO actually has a database in there where it calculates your score. So you can go in there and see what your FICO 2, 4, and 5 is for auto loans so that you know where you stand when you go in, what they're going to see. That's the whole thing. Having the information is so powerful so you know where you stand and what your odds are, right? Because you don't want to waste time. You want to know what your odds are before you walk in there. Knowing what your odds also has to do with knowing what a strong credit profile looks like, right? Because there's definitely a lot of confusion about that. A lot of us spend a lot of time looking at credit scores and not considering the actual credit profile. We're going to dive right into that next. I've created two different examples for you with identical credit scores. A strong credit profile is going to have a credit mix. You can see you have a car loan. You have three different credit cards here. Okay. You had the car loan for 2 years, was paid on time. You got three different credit cards, and now pay attention to the limit amounts. The limit amounts are at 10K for each card, and you've had these credit cards, these different credit card accounts for 3 years at least. Okay. So you spent 3 years managing 10K limits on each card, which is $30,000 total of credit. And kept your utilization around 15%. okay? Or at least when they pull your credit, that's what they see, right? This is going to be considered a much stronger credit profile than this credit profile over here that has a 700 credit score with only 2 credit cards, and they're only at $750 each in reference to limits. And they've only had their credit cards for at least 6 months. Now, yes, their utilization is low, which is great, but this is what's adding to their 700 credit score because they have low utilization. They have their 2 credit cards. They paid them on time for the last 6 months. So at minimum, they have a 700. But again, this is still significantly weaker than the strong credit profile for the reasons we discussed. All right. So now let's do a quick recap of everything that we learned today. Pretty much the main important points, which is number one, if you don't pay your bills on time, you're going to go to credit jail for 7 years and nobody's going to want to give you money. Number two, keep your credit card utilization under 10%. We're not shooting for average results. We're shooting for excellent results, okay? Because we saw, based on our chart that we looked at, that under 10% is excellent and 30% is just good or average. If you really want to knock it out of the park and make sure that you're maximizing your limit approvals, your credit approvals, this is how you're going to do it, all right? And while installment loans can feel like a jail sentence, diversity in credit types is a necessary evil in building a strong credit profile. Credit cards are easier to handle because they have more leeway, right? And installment loans, there's no leeway. there's literally just no leeway. It's just that payment every single month for what seems like 30 years. If it's a mortgage, that's exactly what it is. So, it can be tough, but this is why lending is what it is. And you have to be disciplined. You have to be able to manage your money. And this is why. So I want to thank you all for watching my presentation today. And if you found value in anything that I shared today, I just ask 2 favors. Just like this video and share it with at least one person that you feel like could benefit from this information. All right. And then make sure you hit that follow button, whether you're watching this on YouTube or you're watching this on Facebook. If you're on YouTube, make sure you hit that subscribe button so you can stay tuned for my next video that's coming up in my series. If you're on Facebook, make sure you hit that follow button. And thank you for your time. Peace.